The average household now spends more on subscriptions than they did on cable television 10 years ago. That number keeps climbing while the value keeps shrinking. According to recent consumer spending data, Americans are allocating larger portions of their income toward services and products that deliver diminishing returns. The relationship between cost and value has fundamentally broken. What made financial sense 5 years ago often represents terrible allocation of resources today. Price increases have outpaced quality improvements across entire categories of spending. Corporate strategies have evolved to maximize extraction while minimizing delivery. Convenience has become the excuse for premium pricing that bears no relationship to actual costs. The modern economy operates on a simple principle. Identify what people will pay for out of habit, then raise prices until resistance appears. That resistance point keeps moving higher as consumers accept new normals without questioning whether the math still works. This isn't about inflation alone, though that plays a role. This is about business models designed to separate you from money through psychological manipulation, artificial complexity, and exploiting the gap between what you think something costs and what you actually pay. Some expenses that seemed reasonable even 2 years ago now represent financial decisions that actively work against your interests. The value proposition has inverted. You're paying more and receiving less across categories that touch daily life. Understanding which expenses no longer justify their cost is essential for anyone trying to build wealth rather than just manage cash flow. This breaks down 10 modern expenses that have crossed the line from reasonable to ridiculous. Some will seem obvious once you examine the numbers. Others have hidden costs that only become clear when you calculate total spending over time. All of them share a common feature. They extract maximum dollars for minimum value while depending on consumers not doing the math. Number 1, cloud storage subscriptions. Everyone needs digital storage. Photos accumulate, documents pile up. The free tiers fill quickly, then come the upgrade prompts. Google One wants $15 monthly for 2 terabytes. iCloud charges $10 for 2 terabytes. Dropbox asks $12 monthly for 2 terabytes. These services have trained users to treat cloud storage as a utility bill, something you just pay every month without questioning. The costs compound over years. That $10 monthly iCloud subscription is $120 annually. Over 10 years, that's $1,200 for storing files. External hard drives offer a one-time cost solution. A 4 terabyte external drive costs around $90. That's less than 8 months of cloud subscription fees. The drive lasts years and stores double what you're paying monthly to access. The counterargument focuses on convenience and accessibility. Cloud storage lets you access files from any device anywhere. That convenience has value for some users, but most people rarely access the majority of files they're storing. Photos from 3 years ago sit untouched. Old documents remain unopened. You're paying monthly fees to store data you'll never look at again. The smarter approach combines both methods. Keep actively used files in free cloud tier. Back up everything else to physical drives you own. This eliminates recurring costs while maintaining access to what you actually use. Cloud storage companies have built business models on the assumption that consumers won't do this calculation. They're betting you'll accept the monthly charge as inevitable rather than recognizing it as optional. Number 2, extended warranties. Retailers push extended warranties on everything. Electronics, appliances, furniture, even small items that cost less than the warranty itself. The pitch sounds protective. What if something breaks? What if you need repairs? The extended warranty provides peace of mind. The reality is that extended warranties are profit centers for retailers. They wouldn't push them so aggressively if the math favored consumers. Studies show that most products either fail during the manufacturer's warranty period or last well beyond when extended warranties expire. The window where extended warranties actually provide coverage for failures is narrow. Consumer Reports analysis found that most people pay more in extended warranty costs over time than they would have spent on repairs or replacements. The companies selling these warranties have actuarial data. They know failure rates. They price warranties to ensure profit margins. You're betting against math that's already been calculated in the seller's favor. A $300 extended warranty on a laptop might seem reasonable for a $1,500 machine. But that laptop either has a defect that appears in year 1, covered by manufacturer warranty, or runs fine for 5 years, well past the extended warranty period. The middle scenario where it breaks in year 2 or 3 and the extended warranty saves you money is the least likely outcome. Credit cards often include purchase protection and extended warranty coverage automatically. Charging a major purchase to the right card can provide the protection you'd pay extra for elsewhere. That coverage costs nothing beyond what you're already spending. Number 3, premium gym memberships. Boutique fitness studios charge $25 to $40 per class. Premium gym chains want $70 to $150 monthly for access to facilities that offer marginally better equipment than budget gyms, charging $10 monthly. The fitness industry has successfully convinced consumers that expensive gyms produce better results. The correlation doesn't exist. Results come from consistency and effort, not from the price of the membership. A $10 Planet Fitness membership provides access to cardio equipment, free weights, and machines. That's everything needed for effective workouts. The premium gym adds eucalyptus towels, nicer locker rooms, and a juice bar. None of those features make you fitter. Boutique class packages exploit social pressure and artificial scarcity. The classes create community, which has value, but that community costs $3,000 to $5,000 annually when you're attending multiple times weekly. Home workout equipment represents a better investment for most people. A set of adjustable dumbbells costs $300. A yoga mat costs $30. Resistance bands cost $20. That $350 one-time investment replaces years of gym memberships. Streaming workout programs cost $10 to $30 monthly and provide professional instruction in your living room. The total cost is a fraction of boutique studio packages while delivering comparable or better programming. The premium gym membership makes sense for serious athletes who need specific equipment or training environments. For the average person trying to stay healthy, it's paying for atmosphere and status rather than fitness results. Number 4, meal kit delivery services. Blue Apron, HelloFresh, and similar services promise convenience and variety. Pre-portioned ingredients arrive at your door with recipe cards. No meal planning required. No grocery shopping needed. The cost per serving ranges from $9 to $12. That's $18 to $24 for a two-person meal. 4 meals weekly costs $72 to $96. Over a month, that's roughly $300 to $400 for 8 dinners. The same meals prepared from grocery store ingredients cost 40 to 60% less. A chicken dish that costs $12 per serving through a meal kit costs $5 to $6 per serving when you buy ingredients yourself. The convenience argument falls apart under examination. Meal kits still require 30 to 40 minutes of cooking. You're not saving time compared to cooking from scratch. You're just outsourcing the shopping and planning. Grocery delivery services provide similar convenience without the premium pricing. Order ingredients online, have them delivered, cook the same meals. The cost matches in-store shopping. You've eliminated the trip to the store without paying meal kit markups. The meal kit companies have raised prices while reducing portion sizes. Early customers remember larger servings and lower costs. The value proposition has steadily eroded as these companies prioritize profitability over customer value. Meal kits made sense as an occasional novelty or a tool for learning new recipes. As a regular expense, they represent paying premium prices for basic groceries wrapped in clever marketing. Number 5, app-based banking fees. Digital banks and financial apps advertise themselves as modern alternatives to traditional banking. Many are. Some charge fees that traditional banks eliminated years ago. Overdraft fees, ATM fees, monthly maintenance fees, instant transfer fees, paper statement fees. The fee structures hide in terms of service that nobody reads. A $3 ATM fee seems minor until you calculate that withdrawing cash twice weekly costs over $300 annually. Instant transfer fees of 1 to 3% sound small until you're paying $15 to access $500 of your own money immediately instead of waiting 2 days. Traditional banks have problems, but many now offer free checking accounts with no monthly fees, free ATM access through large networks, and no charges for basic services. Credit unions typically offer even better terms with lower fees across the board. The app-based services succeed through design and user experience. The interfaces are beautiful. The features are convenient. But beautiful design doesn't justify paying fees for services available free elsewhere. Some digital banks are genuinely fee-free and provide excellent value. Others use the appearance of innovation to repackage old fee structures that customers fled from traditional banks. Reading fee schedules before opening accounts reveals which category a service falls into. Banking fees represent pure loss. Every dollar paid in fees is a dollar that could have been saved or invested. Choosing accounts that minimize or eliminate fees is among the simplest ways to keep more money. Number 6, premium cable packages. Streaming was supposed to kill cable. For many households, it did, but millions still maintain cable subscriptions that cost $80 to $150 monthly. The justification usually centers on sports or news. Those channels aren't available through streaming, except they increasingly are. ESPN Plus costs $10 monthly. Sports streaming services provide access to games for $20 to $30 monthly. News channels stream free with library cards in many areas. YouTube offers countless news sources at no cost. The cable package that costs $120 monthly is $1,440 annually. A combination of one or two streaming services and a digital antenna for local channels costs $300 to $500 yearly. The savings exceed $1,000 annually for essentially the same content access. Cable companies know they're losing subscribers. Their response has been increasing prices on remaining customers rather than improving value. The death spiral continues. Fewer subscribers means higher per customer costs means more cancellations. Inertia keeps many households paying for cable. The service has always been there. Canceling requires action. Exploring alternatives takes effort. Cable companies depend on that inertia. They make cancellation deliberately difficult. Phone calls, retention offers, threats of losing email addresses tied to cable accounts. But one phone call and 30 minutes of mild inconvenience saves over $1,000 yearly. That's an hourly rate of $2,000 for your time. Number 7, daily convenience store purchases. A bottle of water costs $3 at a convenience store. The same bottle costs 30 cents per unit in a bulk pack from a warehouse store. A bag of chips costs $2.50. The same bag costs 90 cents at a grocery store. Convenience stores charge 50 to 150% markups compared to supermarkets. The business model depends on immediate need overriding price consciousness. You're thirsty now, you're hungry now. The extra dollar or two doesn't register as significant, but daily convenience store stops add up devastatingly fast. A $5 daily purchase is $35 weekly. That's $180 monthly or $2,160 annually, all for items available elsewhere at half the cost. The pattern often includes energy drinks, coffee, snacks, drinks, lottery tickets, and tobacco products. Each item carries inflated pricing. Combined, they create spending that rivals car payments. Breaking the habit requires planning ahead. Keep water bottles in your car, pack snacks before leaving home, brew coffee in a travel mug. The minor effort of preparation eliminates the need for convenience store stops. Some purchases are genuinely about convenience in moments of actual need. Most are habits formed through repetition. The store is on your route, you stop without thinking. The purchase happens automatically. Tracking convenience store spending for 1 month shocks most people. The total seems impossible until you see the receipts. $2,000 annually buys convenience you could have provided yourself for $200 with minimal planning. Number 8, luxury car leases. Leasing a luxury vehicle creates the appearance of wealth while ensuring you'll never build any. A 3-year lease on a $50,000 car costs around $700 monthly. That's $8,400 annually or $25,200 over the lease term. At the end, you own nothing. You return the car and either lease another or scramble to buy something. The lease payment never ends because you're always paying for depreciation on someone else's asset. The alternative is buying a reliable used car for $15,000 in cash. You own it outright, no monthly payment. The money that would have gone to lease payments gets invested instead. Over 3 years, that's $25,000 invested rather than spent on temporary access to a car. Leases come with mileage restrictions, wear and tear penalties, and disposition fees. Exceed the mileage limit, and you're charged 20 to 30 cents per mile. Return the car with minor damage and face bills for hundreds or thousands in excess where charges. The car companies love leases because they ensure continuous revenue streams. Customers never stop paying. The vehicle returns to the dealer for resale as a certified pre-owned car, generating additional profit. Leasing makes sense in narrow circumstances. Business owners who can deduct payments and need new vehicles regularly might benefit. For individuals, leasing is paying premium prices for the privilege of never owning anything while building no equity. Number 9, name brand medications. Advil costs $12 for a bottle of 50 tablets. Generic ibuprofen costs $4 for the same quantity and dosage. The active ingredient is identical. The effectiveness is identical. The only difference is the brand name. This pattern repeats across all over-the-counter medications: allergy medicines, pain relievers, cold medications, stomach remedies. The generic versions contain the same active ingredients at the same concentrations. Federal regulations require bioequivalence, yet consumers pay 2 to 3 times more for brands they recognize from advertising. Prescription medications show even more dramatic pricing gaps. Generic prescriptions cost a fraction of brand name equivalents. A 30-day supply of a common medication might cost $80 for the brand name and $12 for the generic. Over a year, that's $816 versus $144. The difference is $672 for identical chemical compounds. Pharmacies often default to brand names unless you specifically request generics. They make higher margins on brands. Asking for generic versions requires active effort but saves substantially. The pharmaceutical industry spends billions on advertising to maintain brand loyalty that has no rational basis. The ads create emotional connections to products that are chemically identical to cheaper alternatives. Switching to generic medications across all categories saves the average household $300 to $800 annually. That's money returned to your pocket for making zero sacrifice in medication effectiveness. Number 10, ATM fees from other banks. Using an ATM outside your bank's network typically costs $3 to $5 per transaction. The other bank charges a fee. Your bank charges a fee. A simple cash withdrawal costs $6 to $8 in combined fees. Someone withdrawing cash twice weekly pays $600 to $800 annually in ATM fees alone. That's paying for access to your own money. The fees serve no purpose except generating revenue for banks. The cost to process an ATM transaction is pennies. The fees are pure profit built on inconvenience. Solutions exist that eliminate these fees entirely. Many banks reimburse ATM fees. Online banks typically refund all ATM fees regardless of which machine you use. Credit unions often participate in shared networks with thousands of fee-free ATMs. Switching to a bank that doesn't charge ATM fees or reimburses them takes minimal effort. The savings are immediate and permanent. $600 annually invested at 7% returns becomes approximately $65,000 over 40 years. That's retirement money you're feeding to ATM networks. Cash back at grocery stores and retailers provides another workaround. Make a small purchase and request cash back. No ATM fee applies. You've accessed cash without paying for the privilege. ATM fees represent among the most easily eliminated expenses. They provide zero value. They exist only because banks can charge them, and consumers pay without considering alternatives. Every dollar spent on ATM fees is a dollar that could have been saved, invested, or spent on something that actually improves your life. The expenses on this list share common characteristics. They've increased in cost while decreasing in value. They exploit convenience, habit, and lack of awareness. They depend on consumers not calculating total costs over time. Each category represents hundreds or thousands of dollars annually. Combined, they can easily account for $10,000 to $20,000 in spending that delivers minimal lasting benefit. That money redirected toward savings, investments, or debt elimination would dramatically improve financial situations. The modern economy is designed to maximize spending. Frictionless payments make purchases effortless. Subscription models create recurring revenue streams. Marketing creates desire for things you didn't know existed. Your defense is awareness and intentionality, understanding what you're actually paying for, calculating what things truly cost over time, recognizing when you're paying premiums for negligible benefits. None of these expenses are inherently wrong. Context matters. Someone with substantial wealth might reasonably conclude that premium gym memberships or luxury leases provide value worth the cost. But most people haven't made conscious decisions about these expenses. The spending happens automatically. The subscriptions renew without thought. The habits continue because they've always continued. Examining each expense category and asking whether it still makes sense for your specific situation is how you stop money from disappearing into things that don't matter. The question isn't whether anyone should ever spend money on these categories. The question is whether you've actually decided the value justifies the cost, or whether you're just paying because you've always paid. Your money either works for you or works for corporations. Understanding which expenses no longer deliver value is essential for ensuring more of it works for you.